I want to begin by asking you, market's been rallying and rallying like how? What are you making of it? Are the macro data available out there? Are the macro numbers supporting this sort of exuberance?
So, good evening and thank you for having me on your show. Look, I think obviously the macros are far better today than they were anticipated to be about 8 or 9 months back. I think the fact that we still haven't entered a global recession is itself a very big positive. I think obviously the negative side is that crude has started to inch up a little bit. It's sort of gone north of 90. And the fact that interest rates, there was some clamor in the market about 3 4 months back that interest rates might come down at some point in this calendar year. I think those expectations have been pulled back. But I think the biggest positive, so to speak, is that globally we haven't entered a slowdown. So I think from a trade deficit standpoint, that should hold us in good stead. But the kind of flows that the domestic mutual funds are seeing, it's quite unprecedented. I think even at 20,000 on the Nifty, some fund managers and CIOs that we speak to are getting about 50 to 100 crores worth of inflows every day. And that's been a bit shocking. And I think till that continues, I think the market momentum may well continue. As surprising as it is, and valuations are certainly starting to look excessive in many parts of the market. But I think more than fundamentals, this has been a liquidity-driven rally, and for the foreseeable future, it seems like that may persist.
All right, and are these numbers sustainable for somebody who's looking to enter market at this point in time, perhaps a young investor? Would you recommend them to enter?
That's a very tough call. Let me spin that question around in a different way.
Okay.
If I'm invested, I have no reason to sell. But if I am putting in 100 rupees today, I would think twice. I think you have a 10-year GSEC that's at what 7.2, 7.3%. There are certain debt instruments that are giving you 7.5, 8%. So if you have other alternatives that are giving you between 7.5, 8% kind of returns at a 20,000 Nifty, I think the odds are equally favorable over there because if you're talking about 8% on a 20,000 Nifty, you're talking about another 1,600 points to be going up from here. On current evidence, I'm not sure that can happen. So I think more than stock and sector allocation, I think it's not a bad point in time to look at portfolio allocation. Maybe reduce some exposure to equities, probably nibble a little bit into gold, a little bit into debt, some into GSECs. The primary position will still be equities. I'd still say be 50, 60% in equities, but I think other asset classes at this level would be looking equally attractive, if not more. But like that being said, like I said, if you are invested, stay invested. But fresh capital at this point, I would be jittery.